Firstly, 1.76 lakh crore is not coming, right? So the first thing to remember is 90,000 crore was already budgeted in the 2019-20 budget. 90,000 crore was budgeted as coming from RBI. Take that out. That leaves about 86. Of the 86, about 28,000 crore was already paid in 2018-19 as interim dividend. So therefore, we're left with around 57,000 crores. What is the use of the 57,000 crores? 57,000 crores by itself in a country and economy of the size of India is not enough of a fiscal stimulus by itself. It can be used as part of a larger stimulus if the government decides that they need to give a fiscal stimulus. If they decide not to give a fiscal stimulus, my guess is that this will go some ways in sort of meeting the fiscal deficit target, on which there is a question mark right now because tax collections have been so far lower than estimated. So 57,000 crores can help there. I don't see that by itself recharging the economy. As I said, it's too small an amount. One thing has already changed, right? One thing has already changed is that a little bit of hope has come back. So what was happening was that there was a general sort of spiraling kind of despair taking hold amongst various economic actors. So that has changed. Now the question is, how long will that hold? That depends upon how the various measures pan out. Auto, I don't see a remarkable revival, but I see somewhat of a revival because the government order for new cars, if they do it fast, as well as the postponement of registration fee, plus the fact that BS4 vehicles have now been said that they are not going to go out of circulation. So all these things together may help somewhat, but not as much, not make up for the 30% or so fall that has happened. Real estate, I don't see any way to make any difference. Real estate is a long-term game of a market correction. Basically, it was getting fueled at the investment end by black money. That is now actually, which is a good thing, gone out of the system. A lot of real estate players who made huge unrealistic bets thinking the party will go on forever are now paying the price. There's a lot of unsold stock. So I don't see any above the board measure by the government really changing the game in real estate. Maybe in low cost housing, maybe. But even there I'm not sure who will build those houses. I'm not very sure who will build those houses. FMCG and consumer durables, again, because of the first set of measures which came last Friday about easing retail credit and pegging bank rates to repo instead of MCLR. Again, there might be easier credit flow and sentiments can change and maybe you will see some uptick, right? But the point is, as I was saying in my edit page piece today, that this has been the longest consumption squeeze in post-reforms India. The Goldman Sachs research says the squeeze happened even before 2018 in some sectors. So you're going on 18-20 months of consumption squeeze. Now to battle against that kind of a squeeze, I think you will have to decide two things. A, you can decide that you will ride this out, hoping that things will get better. We will ride out, let's say, 1 year, year and a half. Or you think that this level of squeeze we can't afford to have in a country which really needs to grow a minimum of 7%. We cannot afford to have this kind of a squeeze. Therefore, we change our fiscal stance temporarily and use government spending, government deficit financings to spur consumption in the economy. There is no institution possible. See, I mean, ballpark people say, I mean, a lot of estimates have been done that of India's GDP growth rate around 1.5 to 2%, depending upon who's doing the calculation, depending upon but the composition of trade at that time, 1.5 to 2 percentage points of the rate of growth was explained by global growth. Now, if a combination of US-China trade war and therefore slowing economy, therefore other factors in, so if it actually US-Germany, the yield curves are already inverted, right? So if major economies do sort of, and China growth slows further, US, Germany, etc. goes into, let's say, some kind of a, even if not technically a recession, really low growth for 4 or 5 quarters, then we should give up on any impetus from the global economy, right? Therefore, it brings back the question, what are the domestic growth levers you have at your disposal, right? Private sector is not going to invest right now because private sector needs to feel a whole lot more optimistic. The financial system is not going to start lending merrily either, right? So in the next 5, 6, even 8 quarters, I don't see any option if you do not want to, if you are satisfied with 5.5% growth, it's okay, but if you're not satisfied, I don't see any option but to relax the fiscal line. Our inflation is low. We have 3% inflation, so we can risk it a bit.